Well, good morning, everyone. Thank you for joining us today. We've got an hour's worth of material, so we'll try to get started right away, right now, and get through it. If you look at the menu on the right, there's a section there. If you've got questions, we're not going to be handling them directly during the presentation. We'll try to handle some at the end if we've got time. If I don't get to a question you've got, we will be responding back afterwards, addressing anything you've got a question on. And I guess what I'd like to say about this presentation today is the first time we've given this particular one, and it's got a lot of information on a lot of different topics on getting out of taxes at the end of the day. So when we're talking about some of these specific issues, there are specialists that actually deal with each of these topics. And if we've got something, let's say a structured sale, I'm going to put you in touch with somebody that specializes in that. If you're interested in more information, we can provide it. But the dirty details, it's going to go from the pros in that space. Same thing with CRTs, charitable remainder trust, stuff like that. And I guess where I'd like to start with is we're just one member of a successful team of investment professionals in your life. It's a complicated world out there. It's getting more complicated all the time. And we like to say, you've worked hard for your money. We work hard to keep it yours. So, the bottom line is I've been doing exchanges for 30 years. My name is David Moore. Once again, I'm one of the founders of Equity Advantage, but my background was real estate investment, and we needed exchange work done, put the company together about 30 years ago now. And then during the ensuing years, we kept having people come to us wanting to use retirement funds to go buy real estate. So we put a company, IRA Advantage, together about a dozen years ago, and that's to handle transactions where people would like to use retirement money in things that Wall Street doesn't sell. Or, our accounts allow you to buy anything you currently have, but anything else the law allows too. But with that said, the only dumb question is the one that's not asked. So don't hesitate to reach out. We'll get you the answers. And without further ado, we'll get started now. Like I said, if you've got questions, get it in the menu off the right. If you're an Oregon broker, this class is certified for 1 hour of CE. And Celia in my firm will be taking care of that. Her email address is listed on the last slide, but it's just cmoore, CMOORE at 1031exchange.com. And yes, she is my daughter, but anyway, she'll take care of you on that stuff. And this should be a good class, should be full of some good information. And I always like to say it's just nuggets of knowledge, right? So one little thing to help you get a deal done or get you where you need to go. If you're a broker, maybe it's opening a door to something. If it's an investor, I figure, hey, every dollar we save you, you've got 3 or 4 more to reinvest. And we want to help you get where you want to go. So here we go. And thank you for joining us today. Tired of the terrible T's, but don't know where to go. Consider these end games. Terrible T's, what are they? Toilets, trash, tenants, turnover. And, it's gone beyond that. I mean, if we're on the West Coast and we've got states now with the COVID situation where, the tenants are told they don't need to pay and until March. And, my question is, who's going to have the money to, pay all that back of rent or lease come March? I doubt if they don't have it today, they're not going to have it then. So I'm pretty worried about that stuff. So what I would say is if you just bought a property, you're going to be in a situation where, maybe you just bought it and you don't really know how you're stuck with it now. You don't want it, and you're looking for options, and somebody's told you've got a 2-year required hold on that transaction, and it's totally untrue. If you and I are brothers and brother or sister or something like that, there's a 2-year required hold on a related party transaction. But arm's length transactions, there's absolutely no stated required hold in the code, and it's really up to you and your tax people. So back to those nuggets of knowledge, back to the experts in life. I think your tax people are one of the most important people in your life these days. As the government starts piling up more and more taxes on us for different things. So just if you look at Oregon, we've gotten hit with two in the last year, one with gross receipts tax, and now they've got a wealth tax that they passed too. So they just keep piling it on, and it gets expensive. It's been expensive for a long time, but we'll work hard to keep your money yours, going where you want to go with it. So bottom line, A real estate investor will not spend a lifetime deferring gains, just simply pay it at the end of the day. So you've got to look at things and say, okay, I've done all this tax deferred exchange. 1031's tax deferral is not a tax-free exchange. I hear that all the time. So you're deferring it until a future date, and you've got to decide when's the best time to pay the tax. And as I said, you could swap till you drop, and at that point, you get rid of any tax, at least the way it is right now. But be forewarned, you know, we've got a presidential campaign coming up. The parties are each taking different courses. And, you know, we've got a situation where just the first draft of the tax reform that the Biden presidential campaigns put out there is an increase in capital gains, elimination of 1031, and elimination of the stepped up basis, amongst other things. So, you know, you got to really be careful out there. The NAR, National Association of Realtors, has saved 1031 you know, several times through the years, more than I wish they would have had to. But, you know, it looks like we're in a fight again. The industry, the 1031 industry has the Federation Exchange Combinators, but we're a small industry. There's only about 100 member companies in that organization that handle exchanging. So, you know, we just don't have the manpower, and we're going to need NAR's help. We're going to need, you know, anybody else's help we can possibly get going forward to, you know, keep this thing in existence. And keep in mind, 1031's been around for almost 100 years now. So it's really something that's been a part of our tax system for a long, long time. But you know, it keeps getting threatened with people's need, the politicians' need for money. So today we're going to give you different options, and we're going to finish up with examples of different transactions we've done during these times. Some of these are dated things. So we've got on those slides, I'm going to give you an example, and I'm going to give you on a lot of them a practice tip on it. Some of those are time related, but there's things that I feel are important to be considering when you're looking at each of these different options going forward. So the first question I've got to put out there to people is, you know, what are you selling? And the thing is, a lot of times it's not real clear, or does it appear to be what you really want it to be? Is it what you want it to be? So a lot of times if I'm talking to a commercial brokerage, I walk in and the brokers say, well, gee, what do I care about Section 121, the universal exclusion for a home sale? Well, it's critical that they understand, because if they've got the clients with large investment properties, their home's probably a large home too, and it might have gains well in excess of Section 121's 250 or 500. Now, keep in mind that was put in place, Section 121, in 97. So 250 or 500 made a big difference in 1997 dollars. Look at where we are today, and I would put out there that the old Section 1034 rollover that was in place before 121 was actually would be better for a lot of people today, just because the 250 or 500 gain doesn't cover people's situation. So a lot of times we'll sit there, and if you've got a client or you have a home that's got gains well in excess of the 250 or 500, I'm going to ask you, you know, do you want to sell that property as a primary residence, or would you be better off maybe moving out of it, establishing it as an investment, and then selling it? You're still entitled to the exclusion as long as you sell within 3 years of moving out. The overage would go 1031. So that's a situation where we're certainly going to be looking at a home and converting it into an investment. There's also situations where we're converting an investment into a home. Let's look at EndGames, for example. You know, you're going the other direction on stuff. So you're going to convert something acquired via 1031 into a primary residence. The government's given us guidelines on how to do that and the timelines involved. So that's something that's not only possible, we do it a lot of times. But as far as people's ability to just buy a property, hold it for a period, convert it, take the exclusion, the days of that happening and taking care of all your gain are gone. They're actually long gone. It's probably been about 15 years now since we've been able to do that. But we've got some other things in place, hold periods and some guidance on that. So it is possible, and we can get you where you want to go for it. Think of a situation where, could you imagine a situation where you've got a single asset with allocations, both Section 121 and 1031. So once again, 121, the universal exclusion applies to what a property is at time of you know, as long as it fits within the 2 out of 5 requirement that's there. 1031 applies to what a property is at time of disposition. So, we have to look at that home and can we convert it into investment? Yes, we can with time. Can we take the investment, convert it to a home? Yes, we can with time. And once again, there's absolutely no stated required hold in the code. So it's really up to you and your tax people how long things have to be held. Now we've got a page that's going to talk about holding periods. It's the next page, and we'll talk about that a little bit more in a minute. But Section 121 applies to anything that fits the 2 out of 5 requirement, where 1031 applies to what something is at time of disposition. So imagine a duplex, half owner occupied, half non-owner occupied. You've got one sale, asset allocations, 2 different directions. Imagine a home with let's say it's an estate, a ranch. You've got the farmhouse and you've got the working land, same situation. Maybe you've got a home with a home office. This is one that really sneaks up on people, because typically if you're taking advantage of some tax benefit someplace, you're going to have the downside of it somewhere else. And if you treat a portion of your home as a home office, then that portion of the home on a sale needs to be exchanged if it doesn't fit the 2 out of the 5 for the exclusion. So does that happen? I bet that 9 times out of, actually probably 99 out of 100, that doesn't happen. But can it be a problem? Yes, it can. In 30 years, I've only had one person tell me they got dinged on it, but it was a real estate broker in a presentation. She said, yeah, I got audited and they knocked me for the portion of my home that I had as a home office. I didn't do an exchange on. So just be aware of that, and look at both codes and figure out which way you want to go on stuff. And we can, like, as I said, shift 121, 1031 into 121, or we can have a single sale with allocations different directions. And really, that's no different than, let's say, if you sold a business, you're going to, or a business with the real, and the property, you're going to have allocations of the business, which we used to be able to do exchanges on. We can't any longer. And then we're going to take the real property component. So depending in that situation, what the buyer and seller, maybe the buyer's doing an exchange, the buyer has to have it in it as real property. Maybe the seller thought that they wanted to sell the real property and the personal property and have larger allocations to the business component. And they start looking at things and say, no, I'm going to get stung on that. So let's try to shove as much value into the real property component as possible. So it's all in the allocations, but we're going to be able to help you either way. And anytime we've got somebody that's got, they're selling a home and they've got gains well in excess of those exclusion limits, we're going to tell them to move out of the property. So what would fall outside 121 or 1031? Okay, property held for resale, something that held that you bought with the intent to turn. So all those flippers, not only do you lose the ability to do an exchange, but you're paying normal income tax on that. So that would fall outside. 1033 is involuntary conversion. So anytime you've got city, state, municipality taking an asset from you, look at it and see if you can use 1033 instead of 1031, because as long as it's via condemnation, then the like-kind rules are going to be via the same as 1031 has, but you've got much improved timelines, and you don't have to use all the equity going forward too. So, once again on this slide, 1031 applies to what an asset is at the time of disposition, where 121's any 2 out of 5, 121 straight exclusion, where 1031's tax deferral, and we can always kick the ball down the road to swap till you drop. So question seasoning, how long is long enough? And this is one of those things that people just throw out there, 2 years all the time, and nothing could be further from the truth. Even in a related party transaction, if I can document there's no intent to avoid tax, the 2-year doesn't apply there. But in this recent court case, we had a situation where we love these in the exchange world when we get court cases that talk about different things on holding periods. And understand that once again, 2-year people talk about all the time, it doesn't exist. If you're pushing me on how long I'd like to see something held, I'm going to tell you a year. The year's based on 2 factors. One, it's been proposed several times by the government, and 2, the break between short and long-term tax rates on assets held for investment falls at that 1-year time period. So that's what I'd like to see, but it's not an absolute. I've got people work with just different tax years, even looks better. But this court case, we had a situation where 4 months, people bought a property, with the intent to quote unquote hold for investment, documented the listings, documented the advertisements for it, the showings, and they could never rent it. They got audited, taken to court, and actually got they prevailed in court. So in this situation, 4 months was deemed long enough. And really, in a transaction like this, a lot of times people, are doing things with a genuine intent to acquire something to hold as an investment. Typically, in this situation, I would really look at it and expect that they probably just wanted to get into the new house, but they argued hardship and so on and so forth. There was a court case I believe it was last year in Colorado, in a partnership exchange. So partnerships, the problem with partnership is partnership interests are specifically prohibited from 1031 treatment. And so under court order, a mother and son had a variety of properties jointly owned via limited liability companies. They ended up in court fighting over them, and the judge deemed that ruled that they needed to break the entity and immediately relinquish the properties via 1031. So that's a court-ordered drop and swap. And drop and swaps are just, for the people that haven't heard that term out in the audience here, situation where we're taking a partnership. Typically, it's a limited liability company with a number of members, and the members want to go different directions. So that partnership interest is specifically prohibited from exchange treatment. So we've got to break the entity, go forward. And the question is, when do we do it? So that's another class. On the details of that, but the bottom line is it had to be broken. The Colorado case, I just brought it up because it just documents once again that holding periods are not the final word on whether something qualifies. It's going to be intent, it's going to be circumstance, and hardship can definitely impact things. If we go back to 121-1031 slide, 121 does not allow prorations unless it's a hardship also. So you can't electively take some portion of the 250 or 500 just at will. If there's a hardship in your life, then there's a proration allowed, but it's not an elective proration. Actually, one last thing on that last slide. Look at the bold at the bottom. Taxpayers' intent is typically much more important than even the length of time the property is held. That's a critical thing. And I've got people that, they'll put in the purchase sale agreements, my intent to hold this as an investment, and I don't think that's necessary, but it's out there. So with that said, think about the COVID situation. Think about what's going on. You might have had bought a property through an exchange, and now it's giving you a hard time. Could you exchange out of it? I'm going to tell you yes. You don't want to get greedy though and get keep flipping these things. You got a problem there. But for you to take a one-time situation, say, look, I bought this, now I've got a tenant not paying me, I don't want it any longer, terrible T's are biting me. Can I get rid of it? And I'm going to tell you yes, but you want to make sure you get your tax people's okay. And a word about that, use your tax people through the year. Don't call them up April 14th and try to get them to work on stuff. Anytime you go to sell a property, first thing you should do is talk to your tax people, get an idea what your basis is and the tax consequence on a disposition. The exchange isn't always the right thing to do. So understand what your tax hit's going to be, and then you can make the intelligent decision on what course of action you want to take. So COVID and holding, I'm just going to say, once again, we've got a situation where there's no stated required hold. It's up to intent. What's going on in your world? If you've got a hardship, I'm going to tell you it is possible to exchange out of that property again. I like simple. So the 4 cornerstones of the exchange process: 1, it's got to be an exchange. 2, the items relinquished and received must be of like kind. 3, the napkin test, and that says you've got to go across or up in value and equity for total tax deferral. And finally, we've got to have continuity of vesting. So the toughest thing in any exchange is time. Second biggest headache is really continuity of vesting. That just means the taxpayer that relinquishes receives. We just talked about that drop and swap, court order drop and swap in Colorado. That's because that's a partnership. The limited liability company with a mother and son is a partnership, and they cannot exchange out of that LLC and into two individual properties. They've got to break the entity either before or after the exchange. Breaking before is a drop and swap, breaking after is a swap and drop. So those things are just it's a headache of our time. And a lot of times you got to look at it, and even a husband and wife in a non-community property state, you can't go in and out of the LLC. So think of the cost of money. If you're buying 4 units or less, it's probably it's residential financing. The LLC is going to cost you more money. So look at things, understand, talk to your tax people when you consider a sale, understand where your tax it's going to be, look at what you've got. Let your broker know, or if you're a broker, you get a listing, that list agreement, get that trio from the title company, and make sure that vesting looks like what you expect it to look like. And keep in mind also that deeded interest, that title of the property doesn't necessarily indicate ownership either. If I sell to you on a land sale contract, for example, I'm going to have title till you pay me off, and yet you own the asset. So you can fix things. You can have the title company draw a correction deed, make it the right way. If you've got a situation where a husband and wife are relinquishing a property, and you get a list and you look at it and say, okay, one of them's on it. Well, do both parties want to be on the replacement property? If so, or do they need to be on there for finance purposes? But you're going to look at it, and maybe even though both parties aren't on that in a husband-wife situation, you're going to look at, well, gee, how long they've been married? Do they file jointly? If so, they've both been enjoying the benefits and burdens of ownership, so you can fix that, or you can leave it alone. Doesn't really matter. But that's that conversation that if we get involved, people ask all the time when we want to get involved with the exchange or the transaction, or when they should think about the exchange. I'm going to tell you, as soon as you contemplate, well, I jokingly say when you buy the property, because like that partnership issue, because when you buy it, you're going to, I say when you buy it, plan for the sale. But ultimately, as soon as you contemplate a sale, you've got to be looking at how you own the thing, what you're going to be doing going forward, and make sure that we can have some time to fix it. On the other hand, if you're closing tomorrow, we can do the exchange for you. I don't recommend that. I'd say, hey, take as much time as possible to think about those things. But these 4 cornerstones is what we're looking at. And number 3, the napkin test, it basically says you got to go across or up in value and equity. Another big misunderstanding in the exchange world is people always say you got to replace debt in exchange. Wrong, 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 and wrong. We might have a situation where we've got, through a downfall, we've got reduced loan to value. I've got people that will call, do I have to pay this thing off if I don't want, before I dispose of the relinquish, if I don't want any debt on the replacement? Totally unnecessary. You can get rid of debt in 2 ways. One, by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding cash. Bottom line, you can always add cash. So cash boot is not able to be offset by mortgage, additional mortgage, but mortgage boot can be offset with additional cash. No problem at all adding money to that transaction. So government has no problem with you adding money. They only have a problem if you want to pull money out of the deal. And actually, one other comment on napkin test, it's not all or nothing. If you need some money right now, pull some money out, pay the tax on it. So just got to be aware that you can't just randomly take money out of the exchange. We're going to talk about when you get access to that money. Also, we've got a slide covering that, which I think is very important today, because we've got people that have gotten into exchanges and maybe they don't want to complete them, or maybe now they're sitting in a situation where they'd like to pull some money out. Timeline's 45 and 180 days, goes very quickly. So they both start simultaneously at settlement. And I would tell you before, if I listed a property with you, let's say I came to you and say, hey, I'd like you to sell my property, you list it, and Friday you've got a cash offer, they want to close it a week from Friday, everybody thinks, hey, that was great, that was easy. If I don't know where I'm going, I do not want it to close next Friday. So ask for whatever time you feel you need. If you list and get an offer right away, ask for that time. It's your job to ask, it's the other person's job to say no. But start looking for the replacement property immediately. Don't wait for the sale either, because you can go out, find a property, you can make the offer, you can put earnest money down, all that's going to be fine. If you've done that, just let us know whether you'd like to be reimbursed the earnest money when we buy your property, buy the replacement property. On the other hand, if we've got your money from the relinquished property, we can forward earnest money on your behalf. Either way is fine. But really, really take your time, plan stuff out. Don't get in a situation where you're letting that timeline bite you any harder than it has to. We did actually, I'm going back one more time, sorry about that. The bullet at the bottom, timelines historically had never been extended for any reason prior to 9/11. Since then, we've had every time we have a presidentially declared national disaster, we're given extensions. We got a COVID extension. It ended the middle of last month. We were expecting another one, but at this point, I would not expect, or I'd be surprised to see some more relief come out. What was given to us was pretty slim, and it's gone. But and typically they're geographically restricted. In that COVID situation, it was wide open nationwide. ID, 3 different property identification rules each works independently of the others. The 3 property rule simply stated 3 properties of any value, wide open with value. Do whatever you want to do. But I have a lot of people call up and say, well, I can only ID 3 properties. That is incorrect. You can ID 3 properties. You can ID any number of properties. So the second rule is the 200% rule. It says you can ID more than 3 properties. Total value of the properties ID cannot exceed 200% of the relinquished property's value. What's a property worth? Is it worth what it's what it's listed for? Probably not. So it could be higher or lower. But the bottom line is truly a value is up to what the buyer and seller agree to. But in this situation, does a property have to be on the market to be ID'd? And contrary to a 1990 audit manual, it doesn't. Right? I mean, you don't have to have property listed to be able to buy or sell it. So the bottom line is it's really you're going to, if you exceed the 3 properties, the value is important. We're going to take the gross value on the sale, double that, and that's where you're looking at the aggregate value of all properties ID'd. And you really got to put a number on there. So you're going to ID those additional properties, put values on those when you ID those properties. Third choice, you can ID more than 3, exceed 200%. You got to close 95% of the aggregate value of all properties ID'd. Means you're buying everything you've identified pretty much. Don't do that one unless you're sure you're going to get them done, because I know even the best brokers once in a while have a sale fail. So and we don't want to be in a situation where we're stuck outside the 45 days and now we can't get anything done and the money's stuck here till day 181 in that situation. So once again, each rule works independently of the others. You only have to satisfy one of them. Change your mind anytime up till the 45th day. Satisfactory ID just means you're giving what the government would deem an unambiguous description of the property or properties you intend to buy. Along those lines, if you're going to buy a piece of it, ID the portion that you intend to buy. Because if you ID, let's say, an entire property and pick up 30% of it, you have to receive what's considered substantially the same thing. That would not be. So if you ID an entire asset, try to pick up half of it anyway. That way, I think you're able to definitely defend what you've got there. If you're buying into a DST, which we're going to talk about later, Delaware Statutory Trust or some type of TIC, you need to ID the portion of the property you're intending to buy. If you're buying a unit of a condo complex, yesterday somebody called up asking, well, do I just need to name the complex? No, you've got to have the specific unit there identified. When can I get my money? This is something that's very, very important for everybody to understand right now, because we used to just refund money. If somebody called us up saying, hey, we put the exchange together, we don't want to complete it, give us some money. And we were happy to do so, and we thought the government would be happy for us to do so, but that's not the case. You can't do that. And those rulings came back in the mid-2000s or so, and you're in a situation today where the procedures are considered flawed, and therefore any exchange using those procedures is flawed in effect if you don't follow what's called the 1031 G6 rules on distributing funds. So in a nutshell, you cannot receive funds until you've purchased everything you have the right to buy. If you want to pull money out of an exchange or out of a sale, you can do it at close. And in our assignment agreement, so when you tell us, we're going to do an exchange agreement, assignment agreements, the exchange agreements between Equity Advantage and the exchange or the assignment agreement is is really going to be the document allows us to assume all rights and obligations of our taxpayer as the seller, the relinquished, and buyer of the replacement property. So in the purchase sale agreement to get the exchange in place, a lot of PSAs now include purchase sale agreements, include boilerplate 1031 language, but if you want to put something in there beyond, you can put something in there as simple as, it is the intent of the seller to, or the seller reserve the right or the opportunity to do a 1031 tax deferred exchange at no additional cost or obligation liability to the buyer. Something along those lines will take care of it. Any PSA that has an assignment in it will allow that to be done, whether you've got a cooperation provision in there or not. But the bottom line is, in our assignment agreement, we've got a little blank, ask whether you'd like to retain any taxable proceeds or potentially taxable proceeds, and you would just write in there how much you want to receive at settlement. It's excluded from the exchange. You can walk out of escrow with that money. The balance of the funds are coming to us. Imagine a mixed-use property. You're going to have a portion of the property being exchanged. In that situation, and our contracts are going to read that we're doing exchange of a portion of the asset, not the entire thing. So, as far as getting your money, if it gets to us now, you cannot receive the funds for any reason inside the 45 days. So, because you've got 45 days to identify what's to be acquired, that money's here through midnight the 45th day. So if you get into it 10 days after you've closed, you said, hey, David, I don't want to complete the exchange. You let us know. We're going to send you basically a distribution form that asks how you want the money, and we can send you a check, wire funds, whatever you need to do on day 46. If you've identified something, you're going to have to rescind the identification. If you don't identify anything, then you're entitled to that money after the 46th day or at 45th day. If you've identified property and you don't rescind the identification prior to the 45th day, even if the properties have sold, the government's position is you could still get them because, once again, the property doesn't even have to be on the market to be identified. So if you identify things and you don't rescind the ID, and for some reason you decide you don't want to buy those properties, now, unfortunately, you're stuck till day 181 to get those funds. So the only exception is if there was what the government would deem an extreme material defect. So if, let's say it's a gas station with leaking fuel tanks, that would be a problem, obviously. Maybe the seller cooked the books on the income on the apartment building. Those type of things, extreme material defect. Maybe the property lines are totally different. Years ago, I think this was probably 30 years ago now, bought a property, actually, the partners in the firm at the time, and didn't have a survey done, and found out the park that was adjacent, that we thought was part of our complex, was actually adjacent to the complex, and that caused a problem. So you don't want those things to happen. But in that situation, that deal was actually overturned and taken care of, just because it changed the value of the asset so much. But in this situation, really on that 45th day, you're either totally committed to completing the transaction, or you don't want to complete it at that point. Don't leave it out there and just assume, hey, if I don't buy stuff. And if you're a broker, think about this. You didn't really find the taxpayer what they want inside the 45th day, and they identified something just in case. Well, now you found the perfect property, and it's day 60. We can't give you the money. So that's where the problem is. Also, opportunity zones, OZs, those things are being put out there as sort of a 1031 fallback, but you've only got 180 days to get the money into those also. So once again, if you want to look at that as a fallback, you're going to have to make sure that you either rescind the ID or don't ID anything. That 45th day is going to be critical for you. Swap till you drop. So these are our opportunities, right? Swap till you drop. That's the way to get rid of all the tax. And once again, we are looking at that potentially going away. We've got to fight for that thing. And one of the reasons some of this stuff goes away, and I think the threats to 1031, people say, well, gee, Wall Street doesn't have those options. Well, a lot of Wall Street money is qualified money, and what I mean by that, it's IRA and 401k money. Automatically, it gets tax deferral. But and I've got a firm that sells those accounts, but I'm not a huge fan of them, because the bottom line is 1031's a wonderful deal. You know, you're deferring everything. You still work on the properties, do what you want your whole life. And when you pass away, your heirs get a stepped up basis, current market value, and have no tax. That's an incredible thing. If we look at IRAs and 401k plans, you don't have that. Bottom line, at the end of the day, with an IRA or 401k, whatever is in that account has to come out. And at 72 years old, you've got to take it out, those required minimum distributions. So, you know, 1031, it's all timing of what you want to do, where, you know, the retirement account stuff's in, it has to come out. You can't even touch it till you're 59 and a half. But when it comes out, you're paying normal income tax on stuff. So really look at this, understand this is something that's there, and hopefully it'll continue to be there. But anyway, so it's just, you know, they want our money, they need our money, and they keep looking for ways to take our money, and we keep trying to keep it ours, keep it yours, and keep it moving the right direction. This is a great opportunity while it's here, so use it. Exchange into a retirement residence. Okay, that comes up all the time. We talked about, you know, a court case, that rescinct case. You know, we talked about that situation where people are just buying into a property and hardship forced a conversion. And, you know, I would expect a lot of times we're seeing that. The other thing this comes up a lot in is people that get divorced, because one party will get the house and the other party will get the income property. The people that get the income property typically don't want to live in the house with the income property, so they want to exchange into something else. So once again, we're looking at doing this, and it's all about the timelines. And, you know, you're just looking at 250 or 500, maximizing, you know, situations there. But, you know, if you look at acquisition of a property, conversion into a primary residence, and a sale, number one, I'd encourage you to hold the property at least a year before conversion. That's not, you know, it's not in black and white, so it's up to you and your situation and you and your tax people. But you know, the government's acknowledged this can be done by putting guidelines in place. What they did do is they said, okay, you can exchange into a property, convert it into a residence, but if you sell it within 5 years of acquisition, it's going to be a fully taxable sale. Furthermore, even if you hold it for more than 5 years, you're only going to get a proration of Section 121's 250 or 500. So this is called the Housing Assistance Tax Act, and it just sticks it to you. And you know, that thing basically is a problem, because it says that the 250 or 500, Section 121 is only going to you know, be applied to the qualified use period. You're going to be subject to tax on the gain attributable to the non-qualified use period between 2009 and the date of sale. So, you know, let's say that you had a property, you bought it in 2010, you know, you bought it and you've held it for investment property during that whole time. So you got 10 years there. You got, actually, let's go back, take a year away. Let's say we do the exchange into another property, keep the math easy. You hold the property for a year, you move into it. Well, you're going to have a decade of non-qualified use. And let's say you hold it for the 5 years that are required. You're going to get, you know, a third of the exclusion. So you're looking at 5 and 10. So 5 years qualified, 10 years of non-qualified. So you're going to get a third of the exclusion. So, you know, talk to your tax people. Once again, understand, you know, that it's not all or nothing ever, and figure out what's going to happen there. But, you know, a lot of times a lot of people do this transaction. I'm going to ask them what their gain is, because if you've got a situation where you've got gain of, you know, let's say $30,000, a tax hit of $30,000, what's it going to cost you to live someplace else for that year? And just make sure that it's the right thing to do. You know, don't do an exchange forcing you into changing your whole life for the next few years, when you really, what you want to do is get into that property. So, you know, we've got a situation once again where you've got to look at the tax and rationalize the deferral of that tax or elimination of the tax. And sometimes it's not the right thing to do. If you're kicking the ball down the street and your life's being put on hold, and you know, there's costs associated with that. Understand, look at financing today. Look at the cost of buying a property. I mean, it's just so low, that interest rate. And you know, what's it going to be like a year from now, 2 years from now, 5 years from now? I don't know. But you know, this is, once again, you're buying a property, seasoning it as an investment, then you're moving into it, you're holding it. And I'm going to tell you, do it if it's a retirement home. You're going to be there for the foreseeable future. Obviously, it makes sense there because you're not going to have any tax consequence. But if you're just doing it to get rid of a tax, make sure you understand what it's going to cost you and rationalize that decision. Exchange until it makes tax sense, okay? 2020 hasn't been a wonderful year for a lot of people. So, maybe this is the year you sell and pay the tax. I don't know. But, maybe you've got some losses to offset in Wall Street. Maybe not. I mean, why is Wall Street where it is today? I mean, it just even, day by day, it's wild to watch what's happening. And there's so many things happening. Even Brexit in London next week happens. So what's that going to do to the stock market? I don't know. But day by day, you watch this. Somebody in my office walked into my office this morning, and she says, like, what is up with the stock market? Up, down, up, down, up, down. But, you got to watch it. One of the problems people, Wall Street says about real estate is, it's not liquid. It's a problem. Well, the lack of liquidity gives stability too. So, anyway, tax sense, offset gains or losses in Wall Street with gains or losses in real property. The problem with a lot of the gains and losses Wall Street people have is they're in IRAs or 401k plans, so you don't get to, you don't get the opportunity to take advantage of any loss there to offset the gains on a personal gain on disposition. But maybe year by year you've got gains or losses. Maybe you're making more or less. Maybe you're going to retire. But that's what we're talking about, making tax sense. Now, I didn't put a slide in here on people's ability to exchange in and out of a state. And a lot of people would exchange out of, let's say, a state that has state income tax into Washington State, Nevada, Texas, Florida, states that don't, and think, well, gee, I'm going to save. Imagine you get out of California, save 10 to 12%. Oregon's going to save 10%. That makes a big difference. And people used to be able to exchange out of the state, hold the new property for a year or so, sell it, and they would entirely get rid of the gain on that piece, that state tax. Well, Oregon saw this happening, didn't like it happening. So they've got a clawback. You can exchange out of the state, but if there's ever a future taxable sale, they're going to want their money. California saw that happen. California did the same thing, and other states are doing the same thing. So just understand what the state laws are in your state. If you think you're going to get out of the state and into a state with no state tax and save yourself that chunk of gain, in most situations that's not possible anymore. On the bright side, the states at least do honor 1031 on both state and federal levels, so they are going to allow you to do it, but they just want the money if there's a future taxable sale. Exchange into a DST, and you're going, well, what's a DST? DST is Delaware Statutory Trust. They came into favor in the early mid 2000s, actually, with the TIC. Tennessee in Common institutionally offered TIC, sort of took a bath in those days, and DST sort of took over. But DST's Delaware Statutory Trust, I consider these things an exchangeable REIT, really, or a mini REIT. REITs, a real estate investment trust, you can exchange it in something called an UPREIT. I rarely see that done, and UPREITs end up absorbed into a REIT, and you can exchange into that UPREIT, but there's no way out at the end of the day. So just understand that if you're looking at UPREITs. A DST is going to be non-recourse debt. You're buying the property. The only downside that I see is lack of liquidity, 5 to 7 years. As far as the returns, just know what they're going to be. They're not going to be as good as you can do if you want to go out there and work on the property, but you don't have to deal with those terrible T's, the toilets, trash, turnover. It's a great end game. It's a place to go. You pick the food group. What I mean by that is, there's a DST for pretty much any asset you want. I mean, if you want hospitality, probably not so much right now. Office buildings, retail space, mini storage, all those things, you can sort of pick it, and you can pick, you can diversify the asset class or region. There's something out there. The other thing that's great about them is they're always out there. And they're a great opportunity. My mom doesn't want to deal with tenants these days, so get her into a DST, and it's going to give her that return, keep her tax deferred entirely. And when that 5 to 7 year term comes, you can just roll into another one if you want, or pay your taxes. Or if you exchanged into it and passed away, your heirs are going to get that step up, and upon disposition, they're probably going to have very little tax exposure when that property does go away. It would just be any gain after they inherited it via depreciation, recapture, or appreciation that would be applied. But these things are out there. They're huge. My advice when you're looking at DSTs, and you're looking at a fractional ownership, typically you could buy an entire property, but typically you're looking at pieces of assets or a piece of a portfolio of assets. If you're looking at a piece of a portfolio of assets, two things. One, just be aware that you're going to have tax work done in each state the DST has of properties, so just make sure you know that. And I guess the other thing is just understand diversification, what it's going to do for you, and that's all good. So if you want geographical, you can diversify geographically or asset class or any of those things you want. And also just understand that each offering is going to have different loan to values. You might have situations there. Some companies actually offer pretty much zero down just to get in things, so you're sort of like buying the debt to fix or to fill that gap on the napkin test, the value and equity requirements of the exchange. And or once again, the napkin test 1031 is not all or nothing. So if you just spend what you want to spend on the replacement and be happy about it. So these things are great. And I guess my practice tip at the bottom is the investment's only as good as the sponsor. So you want to make sure you're working with somebody. We're going through some hard times right now, and I guess there's about a half dozen of these companies that were around pre-crash last time. And my advice is probably to work with those companies that have been through this before, so that if there's ever an issue, they're probably going to be more prepared to deal with stuff. But you want somebody that's going to be strong and somebody that's been there and been doing it for a long time, because literally you're buying an asset that they're going to manage, and you want to make sure that it's as good as you want it to be, and you want it to be there for the investment life that you've got there. The other thing is, like I said, not only are you buying a piece, but you need to identify that portion that you're going to acquire of that DST. And the bottom line there is that don't identify a DST and think you're done. Identify the portion that you intend to acquire. That's a big difference. There is some debate on how you properly ID a DST. And whether or not if it's a multi-asset DST offering, if each asset has to be listed, or if it's just a DST. My personal opinion is actually a little outside what I think our industry's position is. And the reason I've got the different position is it's just unification of a transaction. You don't have the ability to pick and choose which assets of the DST are possible. It's all or nothing. So when you're looking at that, since you don't have the ability to bust things up, it's all or nothing that you're buying. My personal position is that you identify that offering, but you want to have that discussion with the sponsor. You want to have that discussion with your tax people too. A lot of the people in our industry are saying that you got to identify every asset in the DST offering, which is ludicrous, and really it puts you into the 95% rule situation, just because it's just really untenable. I don't see how you can argue that's the way it is, but be aware that that's an issue for DSTs and actually institutionally offered TICs too. So DSTs are typically used for things that are going concerns. They're not going to be a value add situation. Tenancy in common, there are some institutionally offered tenancy in common. Typically TICs are let's say you, me, and a group of our half dozen friends go buy a property. And if we're going to exchange to it, it has to be tenancy in common. We cannot, as we said earlier, partnership interests are specifically prohibited from 1031 treatment. So you can't just exchange in or out of an LLC. We've got to break the entity into tenancy in common to be able to do that. And so that's why the tenancy in common structure is so popular. TICs historically were just for that example of a group of us going to buy something together, but they were sort of taken over by the institutional world in the late 90s, and when we had the blow up that crash, it definitely beat up the TIC world, and we had a situation where we had so many sponsors that went away, and so that the TIC structure sort of took a beating, and really it wasn't the TIC structure's fault as sponsors. I have no problem with TICs. You just got to make sure that the practice tip at the bottom. People don't think about it. Even if I go out, let's say two of us go buy a property, a vacation property, and you know, it's VRBO or we're renting it out, whatever it is, and ultimately we just, you know, use it partially too. We got to be careful. We've got second homes have a totally different set of rules, guidelines for 1031 treatment. So we don't make sure that we're treating it as an investment. But, you know, let's say that you decide, or you know, or I decide I don't want the property anymore, and you own that property with me. I don't own it. You probably want to be able to choose who's going to buy into it, or you want to probably be able to, you know, maybe buy my interest, or you don't want to pay any additional fees for a, you know, a loan that's now probably going to have to be changed. So you've got to have a TIC agreement there. Even between two people in a property example like that, you should have a TIC agreement spelling out what's going on. And I see so many tenancy and common ownerships that have no agreement whatsoever there. And I just put it out there. How do you decide? How do you reconcile different problems, different situations? Because we're always happy when we go buy things. But, you know, a lot of times we bought stuff, they've run their course, and now we're just wanting out of it. And you got to plan for that sale when you buy, and that TIC structure is going to allow multi-owners to go different directions on disposition. If you're buying into an institutionally offered TIC, they're used for value-add situations. You got to be careful. In the DST, the debt's non-recourse. Always non-recourse. If we're looking at TICs, some are going to be recourse debt. You just got to be aware of what's going on there. And I guess a comment on basis gain and recourse, non-recourse, understand that on income properties, you know, in a foreclosure or short sale, you know, the debt on the property is going to be considered the sales price if it exceeds the sales price in a short sale. If it's a foreclosure, the debt's going to be considered the sales price. So if the sales price exceeds your basis, you've got something called phantom gain. You're going to have a tax hit. You have no tax relief on income properties. Residential properties you do. But understand that you know, you're going to have a situation potentially there where phantom gain is going to trigger a huge tax problem, even in a property that was lost to a foreclosure or short sale. Understand what's there, understand what's going on, and how we're going to get people where they want to go. But TICs are going to give you that value add situation opportunity, and they're going to get you where you want to go. Once again, work with a company that's been through this stuff, understands what's going on. Installment sales. Well, hey, gee, I just I don't want any real estate anymore, so I'm just going to sell and carry the money, carry the contract or note trust deed. And the bottom line is, if you sell for cash, get the money into a bank account today, what are you going to get paid? You get nothing on it. So if you don't want to do an exchange, and you think that installment sale is going to be the secret for you, great. That's going to be fine. Understand a couple things. If you sold unencumbered dirt, great. You've got pure installment sale. You're not going to have to pay any taxes until you got principal payments. Interest payments going to be taxed at normal income tax rates. The principal payment's going to have that long-term capital gains tax treatment if you held the property for more than a year and held it for investment. But the other thing to be aware of, if it was encumbered property and it was improved, let's say it's an office building. Now you've got, even if you didn't get a single payment on sale, or you didn't get any down payment at all, let's say, and you better get enough to cover the broker's commissions, you know, any tax and legal fees, escrow, my fee. You know, we probably all want to get paid at close. The brokers, like I said, you're going to want to get paid. You better get enough of down payment to cover all those closing costs and any tax that you're going to be subject to on depreciation, recapture, or debt relief. So in an installment sale, this is something people don't think about, is that if you've got an encumbered property that's got depreciation on it, even if you didn't get any money, you're going to have tax exposure on debt relief and depreciation recapture in the year of sale. The balance of it, you're going to get that long-term treatment, the installment sale treatment on, but you've got to make sure you understand what costs, what your tax liability is going to be in the year of disposition. Don't just think, hey, I'm not taking any payments, I don't have any tax. It's going to be there if you're not careful. So once again, who'd I say was very, very important in your world? Your tax counsel, and you're going to want to talk to them about this stuff. Structured sales. So A structured sale is really an installment sale that's institutionally offered. So what happens is a third-party assignment company comes in, assumes the obligation to pay. And you know, once again, we're looking at with the installment sale too. I said if you put the money in the bank, you're not getting anything. So if you're getting, you know, 5-6%, that's a wonderful thing on the installment sale. If you sold to somebody in the cannabis world, maybe you're getting 19%. Who knows? But yeah, you know, the bottom line is where you're going to get 5 to 6 these days, and you know that's totally safe. And the only problem with a regular installment sale is if the person defaults, or let's say that you did not put an acceleration provision in that thing. Now you're going to be stuck because you know, an accelerated payment, you know, where that thing was, you were told, hey, I'm going to pay you over 10 years, but these rates are too low now, so I want to do a cash. You know, I want to refi that property, get you out of that thing. I'm tired of paying you that expensive money. So you thought you're getting 10 years of income and you're getting a year's worth. And now you're calling me up wanting to do an exchange because now you're getting the payments for that contract or note. It's too late. As soon as you've got the note, you're going to have a tax obligation. It's just a question when you've got to pay the tax obligation. Charitable remainder trusts. Well, you know, these things get complicated, but bottom line, if you got a question on it, call up Tina in my office. She'll take care of it. But she was in the CRT world for a long time. And you know, we don't see a lot of these done, but bottom line, CRT is a tool that enables you to give to charities, reaping financial benefits. So you're going to get some tax deferral. It's not, once again, a tax elimination. You're going to have, you know, tax in the future, but this is a great way to get, if you've got some charity you love and you want to give them some benefit, you want to have some tax benefit, this is a tool you can use. And you know, it's a great thing. You can actually have it where your kids are actually gaining benefits, so it can go beyond your life too. But this is one of those things where they're going to tailor it, just like a structured sale. They're going to tailor the term to what you want to have there. And you know, the structured sales, you've got a situation where you literally figure out, you know, how long you want it to be, and it could be a year or it could be months. It could be decades, and really you're going to work with professionals in this space to figure it out. Some companies, or some I shouldn't say companies, charities, for example, Providence has a charitable giving department, and they've got people in-house that specialize in this type of stuff, and you know, they're going to be able to, you know, really talk you through it. And you know, once again, look at it. You've got to understand there's cost associated both this. And you've got to look at structured sales too. You've got to understand there's costs associated with structuring it. So understand what's going on and what it's going to cost you, what you're ultimately going to be paying, the deferral and what's happening there before you go into it. This has to be set up, you know, pre-disposition. Structured sale actually can be used as a fallback if we integrate it into an exchange agreement. But if it's not integrated in the exchange agreement, it's not going to be a fallback. We are getting out of time, and as usual, I'm behind. Gifting's another situation that you know, I had a conversation with somebody yesterday, and we're talking about financing something, and he said, well, gee, you know, or what happens if I give the property to somebody else and I buy it back? You understand, when you give a property, you're giving that person or persons whatever the equity is in that property. You can't just deed properties back and forth without a tax consequence. So, you know, who's got the tax consequence? Not the person receiving the gift, the person granting the gift. So what are the gift tax limits? They're $15K per person per year right now in cash. But if we're looking at a piece of something, we've got a huge opportunity there. Because, you know, we have a lot of times where somebody will give up a property, they got 2 or 3 kids, they want to go buy each of the kids a property, or they want to give money to the kids to go buy properties. I'm going to say, let's go buy the properties. Let's buy each of the properties in an LLC. And then what we're going to do, instead of giving a property to that kid or to whomever in the future, gifting them the whole thing where you're going to get clobbered with tax, or looking at that 15 per person per year, if we're looking at a minority interest in some, we can actually accelerate that dramatically, because the distribution can be discounted, the gift can be discounted by up to 40%. So a lot of times what we'll do, using the structure I just talked about, is we'll exchange into the 3 properties, you hold them for a year or so, then you start assigning a membership interest. And by assigning the membership interest, you don't even have to deal with deeds on those assets. So that assignment of membership interest each year, you're going to be capping the value of that, to the 15 plus whatever the discounting, the 40% is going to give you on that thing, and take full advantage of that. And keep in mind, if there's 2 of you, a husband and wife, giving to the kids, you got 15 per person, per year each. Or you're looking at that, that accelerated because of the discounting, the 40%. Now, I use the same structure when we're looking at distribution assets out of IRAs and 401k plans too. And I think it's a huge opportunity for people, because if you buy a piece of property, with a retirement account, you want to move into it at some point, you can do that. But you wouldn't want to take the entire property out as distribution 1 year. You want to use the same structure and take pieces of it out over a number of years. That way you're going to be able to apply that discounting, which is just, once again, a huge opportunity and something that just isn't brought up very often. Improving property already owned. This is sort of, one of those things that we're doing a lot of right now, simply because it's so hard to get a shovel in the ground today. And I apologize, we've got a few examples after this slide and it will be done. We are over. We're probably going to be about 10 minutes over. But if you have to go, the slides will be in the presentation that is going out if you're wanting credit hours, or it's going to be available. A video of this is going to be available for later viewing also. But if you look at this situation, we're doing a lot of improvement exchanges into property already owned. And the problem is, in today's world with improvement exchanges, how long does it take? We used to have President Obama talk about shovel-ready projects. Well, today, in today's world, how long does it take you to get a shovel in the ground? I'll tell you, in Oregon, you're not going to get a shovel in the ground in 6 months, and that got that 45 180 to 1031 house. You're not even going to be ready to get started. But you might have a property that you've owned for years, and you've got property you no longer want. Well, give up the property you don't want via the exchange, and we are going to enter into a leasehold agreement with you, a long-term leasehold interest in real property, a leasehold interest of 30 years or with extensions to 30 years or greater constitutes ownership of real property. So, this slide talks about 35 years. A lot of times we'll just have that in there, but the bottom line is that we're going to create an LLC, enters into a long-term lease with you, and we do the improvements on a leasehold basis, convey the leasehold improvements back to you, completing the exchange, and you've truly received new real property that you've never owned. And why that's important is, when we got guidelines on reverse exchanges in 2000, one of the safe harbors prohibited receipt of property already owned as replacement for property being relinquished in the exchange. So this is something that's a little out of the box. You might think it's a lot out of the box, but it's something that is possible. And it allows you to get the plans, engineering, permitting all set, and either the lease date starts the clock, or the date a transfer occurs on the relinquished property is going to start the clock, get you going. A few examples were done. This example, first one, we're talking about an opportunity that's here until roughly September 22nd, not roughly, exactly September 22nd. So maybe you've got a property you're having a hard time with, or maybe you've got a perfect replacement property that you want to buy and yours hasn't sold yet. You don't have the money to go buy it. Well, we've got, through the CARES Act, we've got access up to $100,000 for 3 years now. So you don't even have to pay anything back for the first year. So if you got some hardship in your life through COVID, you've got that CARES Act, you've got the ability to take up to $100,000 and use that to go buy a property. So we've got situations where we've got people looking to do that for business startups these days. We're looking at situations where we're doing that for reverse exchanges. We've got what's called a 60-day rollover that's always there with retirement accounts. We use that rollover in reverse exchanges a lot of times too. But be aware, some of these things have a ticking clock and a date they go away. So we need to make sure we're aware of them. And this $100,000 is a great opportunity for people that have money in a retirement account but have other needs where they want to get something taken care of. Why not use this while it's available? Second example, this is just a situation where, if you remember one of the early slides talking about somebody's home and Section 121, the gains are well in excess to their $250 or $500. This situation, they had a $3 million gain or and the exclusion was only going to protect 5,000 or 500,000 of it. So that was going to do nothing. They got referred to us by a law firm. We told them to move out of the house. So what they did is moved out of the house. They took some money, went and bought a new home, held it for a year. That's what they and their tax people were comfortable with. Then they sold the property, exchanged. They had roughly $1 million tax it when they came to us. And when they were done, they had no tax, had 24 different replacement property, closed them all inside the 45 days. And that was a lot of work. But the husband was a lawyer, the wife was a CPA. She knew the hardship of not getting things done, fitting that 95% rule. So she just worked to get all closings done inside the 45 days. 24 different properties, $1 million initial tax hit, no tax hit at the end of the day. Happy clients, happy brokers, happy title escrow. And the tax people were happy. So it's a great situation, and I think great example of a great opportunity. This is something that is not a 1031, but I just want to throw this out here once again, using retirement money to save a property. The situation where son had a property, $3 million property, $1.2 million equity or debt in it, $1.8 million equity. Wanted to use dad's IRA to pay the thing off. The bank was going away. It was failing. This was the last crash. So the bank was failing. If the bank went, his property, he was going to lose $1.8 million. So, you can't legally just take dad's retirement account, pay off a property. That's a prohibited transaction. So we created a new limited liability company. Junior put the property in. Dad's IRA made an investment into that LLC. The LLC now owned the property, had the cash to pay the property off. And that's what happened. So we saved the property. Ultimately, they built a multifamily project on it, got everybody where they wanted to go. All or nothing. You don't have to do all or nothing in an exchange. Now, if the boot received exceeds the total amount of gain, then there's no benefit to the exchange. So think of it this way. Whatever your basis is, every dollar spent over your basis is going to represent tax deferred gain. These people gave up a $3 million apartment complex. All they wanted was $1 million property in Palm Desert. So they had $2 million in boot. You're going, man, that's a big tax hit. Yes, you're right. Probably $600,000-$700,000. But all they wanted was $1 million hit, the $1 million property. So their basis was $250,000. They deferred gain of $750,000. They still saved $250,000 in tax. So I'm going to say, get what you want to buy. Every dollar more you spend on something than you want costs you $1. If you don't spend it, maybe it's 30 cents. If your basis is $500,000, you spend $600 on a replacement. You're going to defer $100,000. Even if you sold $1 million property. So once again, $500,000 equity, $1 million or $500,000 basis, $1 million relinquished property. To be whole, you need to go $1 million net of closing costs. But if you just want a $600,000 property, you're deferring tax on 100, it's going to save you 30 in tax. So get what you want to get, pay tax on what you're comfortable paying tax on. I've had CPAs that don't want to pay tax of $5,000. I've got people that will willingly pay tax of $800,000. I never judge people. Everyone's got their own unique situation. But just look at the numbers, sharpen your pencil, then you can make the informed decision and choose the right choice going forward. Opportunity 5. Now, this comes into that comment on phantom debt or phantom gain, not debt. So in a situation where we had the last crash, we had people losing properties to foreclosure. And in a TIC foreclosure, each TIC ownership is typically via limited liability company. So we just have that assignment of the membership interest pre-foreclosure. When the property was foreclosed, it was ours, not the taxpayer. We isolated them from constructive receipt or actual or constructive receipt of debt relief, and they're just going to have to come out of pocket, go buy a new property of equal or greater value to whatever the debt is on that relinquished property. A lot of times the tax consequence is actually less than what the requirement of equity going forward was. So this is something that hopefully I'm not going to see a bunch of going forward, but it's something that worked well last time. This, I'm throwing a curveball at you. The last example, nothing to do with an exchange, but I just want to say there's opportunities that are out there. And this is one that a lot of you might not have ever heard of. It's called a rollover business startup. The acronym's sort of unfortunate, it robs, but in this situation, people came to us, and this is a teaser to make you sign up for our next presentation, the next webinar on IRAs and 401k plans. But in this situation, husband and wife, retired, came to us. They wanted to go buy a mobile home RV park using their respective IRAs. And typically we do something called a checkbook IRA to buy it. Once again, you can come next time and listen to what that is. But instead, that would have been a prohibited transaction using IRAs. But what we ended up doing is create a new 401k plan, rolled each of their IRAs in the 401k plan, created a C corporation. The plan bought the corp bought the mobile home RV park, and these people got the investment they wanted. And they wanted to be the on-site managers and take compensation, so they got a job, a place to live, and an investment, all with this structure. So I think it's an amazing opportunity for people. You can do a bed and breakfast, something else too, but that's something that is out there, and it's something most people are not aware of. The franchise world loves it because we do a lot of these for people that maybe they want to go out and buy a property and put a laundromat in or something like that. Any of those things are going to be situations where we can use a rollover business startup, taking their retirement accounts, and maybe you salvage somebody's life using that thing, or get them where they want to be, can be. So this slide just talks about our services, and I'm just going to point you to that. See more at 1031exchange.com if you're needing to reach out to us. We've got IRA Advantage to handle self-directed retirement accounts. Equity handles the exchanges. Post 1031 is a property listing site. Thank you very much for your time. I am over, obviously, and I apologize for that. Hope you've enjoyed it. And since we are so late, I'm not going to be taking the questions at this time, but we will be reaching out and addressing those via the response on CC. So please don't hesitate to reach out with questions. Look forward to working with you. And as I said earlier, the only dumb question is one that you don't ask. So if we can be of service to you, even if working with another firm, don't hesitate, reach out. Thanks again, and I look forward to speaking with you and working with you in the future. David Moore, Equity Advantage, 1031exchange.com. Thank you, and be well.
Nice.
No question. I didn't see how many people were on there the whole time. Were you watching at all?
I can't see how many
There's
people.
22 on there now, still.
I can't see how many are on there.
Okay, Mitch
But
Teal.
I can see them.
Mitch Teal.
Yeah, I'll see how many attended afterwards. I also called, GoToWebinar, because that definitely looks different, right, than it's ever looked before.
Well, mine's fine. Yours was different.
Okay. So yours didn't have that gray bar in between you and the, oh, that's good, because yours is recorded.
No, mine was good.
Nice.
We need to get, huh?
It takes probably about 40 minutes to get there.
Yeah, and it's 12 after, so
Yeah.
8 minutes and we gotta be.
Nice. So she found one error, the CARES Act slide.
Oh, because it still says 3-year payback.
I know, I put that on
Okay.
there. I
So
saw that.
Is
yes.
the one that you sent us fine for me to send out, or do you need to send me that one? That's the only thing I need to
Just so
get
we
them.
can update the 3-year to say.
Okay, we can change that, and then there was one other change you had me make.
It was
right?
the link, which looks good.
The post-10.
The blue link, it looks good.
Okay.
And it's done.
So the one you sent me, I'll just make that one change, and then that's fine to send to all the attendees.
Yeah.
Okay. Nice.
Promote attendee. What's that?
So even that, like
Leave
they
or end
updated-
webinar. Well, I mean, it's good they're updating it.
Yeah. Let me see how many. Did you get a lot of questions?
You can promote an attendee to an organizer, allowing you to leave the webinar.
You got a few questions.
I just wrote
See?
that I couldn't.
No, I didn't get
So
it. And I
there's
think
Brad, go down. scroll. Your mouse isn't on that. Yeah. Cancel.
Thank you. Will you be emailing Stacy? That was it. No questions.
What's that? Celia. It's Patrice.
So her husband signed her up.
Okay.
You're going to see that message, right?
Oh, I think so. Yeah, actually, I think so.
Or should I copy it? We don't know. Patrice Cook.
I have her number. Yeah.
Okay, so I don't
Yes.
need doing
No.
this.
Yeah, you're good.
Okay.
Nice. I'll see how many were on there right now.